I am so stoked right now. You won't believe it. We are on the road to one of the most important concepts that you will ever need to know in order to do proper financial accounting recording.
I show you how deep the rabbit hole goes.
Okay, gang. In our last video, we introduced the two major components of financial recording, what happens to be the ledger and the journal. So within the ledger, anytime that a particular transaction affects the business, it's recorded in the journal and then it's posted in the ledger. The ledger will show you for each particular account its effects and the ending balances.
Sensational.
So today, we are going to uncover how to properly record transactions inside of the journal. And this particular process is critical for both the recording part of accounting as well as the reporting part, because I want you to understand anything that we record within the journal gets posted to the ledger. And if it's in the ledger, it will then be created in the financial statements. So how we properly record the transactions affects how the information is being reported. So this is very critical, gang. And in terms of an accounting, this pretty much sits on the foundation of what accountings do, record information. And so this particular process is called double entry accounting. But 3
days later.
Blue moons ago, came up with a simple method when I was in undergrad, how to record properly. So inside the ledger, we already know that each account has two sides. A left side, which we also call debit, and a right side, which we also call credit. And so what you must understand, gang, is that when an account is affected, it could either move in two ways. It could either go up in a business or it could go down in a business, decreasing. The dilemma comes in that we have certain accounts that increase on the debit side, the left side of the ledger. Likewise, we have certain accounts that increase on the right side, the credit side of the ledger. And so we have to keep track of what accounts increase on the credit side, what accounts increase on the debit side, what accounts decrease on the credit side, what accounts decrease on the debit side. Confusing, ain't it? But I came up with a foolproof way that can assure you to master this double entry method to the T and never get it wrong. Okay, so the name of this method is called the AWE system. And basically what I've done is I've categorized the accounts into two opposing parties, two groups that don't like each other. Consider them gangs. And so we have the AWE gang and we have the CLR gang. And so AWE represents an acronym. And within that acronym, let's discover what accounts belong in that particular group. So A stands for assets, W stands for withdrawals. Now, when we speak of withdrawals, gang, we're talking about when the owner withdraws funds from out the company. Okay? And so if we're reporting for a corporation, we know who the owners are. The owners are the shareholders. And so with that being said, when shareholders receive funds or income from the corporation, we call that dividends. So withdrawals are just simply dividends. And last but not least, expenses. Any type of expense will be considered a part of the AWE gang. So who's in the CLR gang? Well, the C represents capital. And when we talk about capital, we're basically referring to stockholders' equity. The two components of stockholders' equity happens to be paid-in capital and retained earnings. Paid-in capital being common stock, preferred stock, and retained earnings, which happens to be the income that we retain. L obviously stands for liabilities. So any type of liabilities we have will belong in the CLR gang. And last but not least, R stands for revenues. So in summary, What accounts belong in the clear gain? We have capital, stockholders' equity accounts, all liability accounts, and all revenue accounts. So we already know these guys can't stand each other. They're always at war, so they're never agreeing on the same thing, even in which way they move up or down. And so when we're talking about the all gain, the assets, the withdrawals, and expenses, they always move on the left side of the ledger, which happens to be the debit side. So all assets, all dividends, which happen to be withdrawals, and all expenses increase by recording it on the debit side, the left side of the ledger. Now, once you memorize that game, everything else is logically sound, right? So if we understand that the all gain always increase on the debit side, well, guess which side the clear gain's gonna increase? Guess which side stockholders' equity, liabilities, and revenue accounts will increase on?
If you already know the answers to your questions, then why ask?
Obviously the opposite, which is the right side. And we know in accounting that right side is called credit. So any stockholders' equity accounts, any liability accounts, and any revenue accounts will always increase on the credit side. So if the all gain increases on the debit side and the clear gain increases on the credit side, how do they decrease? Well, it's logically sound. If the all gain increases on the debit side, they have to decrease on the credit side. So anytime that cash is going down in the business and cash happens to be an asset, it has to be credited. So if the all gain is going down on the credit side, obviously the clear gain is going to decrease on the what? Debit side. If we have to decrease an account payable, obviously by the last name, remember the tips that I give you. If it's a payable, it's a liability. So if it's a payable and it's decreasing, it belongs in the clear gain. How do we decrease it? We will decrease it on the debit side. And so with that being said, I like to briefly go over a few transactions so that you could easily identify how to apply the all clear system. Okay, gang, so now we're going to take a look at how to apply the all clear system to a transaction. What I strongly suggest is as you work your assignments or if you're taking a test or whatever have you, always just notate the all clear system in the corner somewhere as we've done before. That way that can be there for you as a guide throughout any transaction you may face. So let's take a look at this transaction. It's a Joe performs services for a customer on account for $1,000. Step 1, let's identify the keywords out of this sentence. Keywords are perform services and on account. Gang, keywords are vital for getting to the right answers in accounting because a lot of times those keywords will direct you to the right accounts that are affected. So, perform services are the keywords. So what account is affected anytime you provide a service or you sell a product? By definition, revenues are earned. So we know that anytime we perform a service, which we've done right now, we've earned some revenues. And revenues happen to be a part of the clear gain. Now, the next set of keywords says that it was on an account. The services were provided on an account. So, gang, anytime you see the word account, two accounts should pop in your head. Either accounts payable or accounts receivable. But they're slightly different and very easy to understand. Accounts payable is an account you set up to pay cash in the future, particularly for something that you purchase. On the other hand, accounts receivable is an account that you set up to receive cash in the future. Therefore, we provided services to a customer and we need to set up an account to receive cash in the future from that customer. Therefore, this is an example of an accounts receivable. And so we know that accounts receivable happens to be an asset, which makes accounts receivable a part of the all gain. Now that we have identified the two accounts that are affected, our next step would be to determine how they are affected. So we perform services. So obviously if we've earned more revenue, revenue has increased in the company. Revenue has went up. So how do we record revenues going up? Well, based on the all clear system, it tells us that anytime an account in a clear gain is going up, we're going to credit that. So since revenues are going up in the company because we provided the service, we're going to credit revenues. But what about accounts receivable? What about accounts receivable? Accounts receivable is an asset. We provided a service, and so we have to set up an account to receive cash in the future. Thus, our accounts receivables have increased as well. Since accounts receivable is a part of the R gain, we are going to debit accounts receivable because it's going up. So let's get to the proper recording. Gain, you always debit first because we read from left to right, so you're going to record from left to right. So we're going to always put your debits first. So we're going to debit accounts receivable because accounts receivable is an asset and it has went up for $1,000. And we are going to credit service revenue. Now, how do you signify credit? Just like you would if you were to start a paragraph, you write indent. So we're going to write indent the account, which means that we're crediting the account. And so we're going to credit service revenue for $1,000. And there you have it. We've utilized the all clear system to get to the right answer. We're nowhere done because our debits and credits are equal. Any transaction that has been completed, the debits must always equal the credits, gang. So that pretty much wraps things up, gang. We have just summarized one of the most critical, most important concepts about financial recording with a very easy all clear system. And so if you master this system, I guarantee the rest of your understanding of accounting will be a cinch.
I'm not going to swear an oath I can't uphold.
With that being said, thanks for tuning into Accounting as a Joke. And if that light bulb is clicking and those neurons are firing, don't forget to like, subscribe, and share this channel with your other friends so that you all can chase the bags with the accounting information. Thanks, gang. See you soon.